is seasonality saved here with the calm September, David?
You know, I think that this is a market that likes to look about 30 seconds ahead of it. And right now,
it's like life. Yes, exactly. Like modern life.
Exactly. And, you know, so we got a Fed cut last week. I think that there are some questions around whether it was a hawkish or a dovish cut. I read it as being a little bit hawkish. You know, trade is kind of simmering, right? No longer boiling over, which I think gives the market some confidence. But to the point Mike just made, right, what the stock market wants is an easy Fed, a deal on trade, and growth to remain moderate. And that's somewhat of an impossible trinity. I'm not sure all those things are going to come to fruition, which probably means that we're looking at some volatility here in the next couple of weeks.
So more downside risk than upside risk?
I think that there's more downside risk right now.
What about you?
I concur. I think there is absolutely a big rotation going on from growth to value and from momentum to contrarian. And I think that that's the setup for the market. It's actually very reminiscent of the late 1990s, 1999 to be specific, when I was managing money back then too. And nobody thought the growth gravy train would ever come to an end. And it came to a crashing halt the very next year. And I think that the valuation spread between growth and value is so large. It's exactly the valuation spread as existed in 1999. So I would say that watch out for that turn and frankly position your portfolios for that turn.
What's different this time than some of the other fake outs when value started showing strength against growth?
I think the banking sector was a head fake within the value spectrum. The banks have completely and utterly underperformed, and they were the weakest link in the chain. That's behind us. Now the things that remain in the value index are the things that are truly undervalued. And of course, the flip side is growth has exaggerated its move up. And there's always a price to pay for something. And I think growth will end up disappointing and value will end up surprising on the upside.
Do you have examples of value sectors that you can pick out where you're seeing it the most?
Absolutely. And I think it also fits the fact that you want to avoid the momentum trade, the FANGs, and you want to buy the MANGs, the non-crowded trades, which is, you know, things like Michelin, which are viewed as consumer discretionary, but really is a consumer staple. You have to replace your tire. In my mind, that's a staple, not a discretionary, but it trades like it's a discretionary. You take stocks like Ahold, which is a food retailer, you know, Whole Foods, the whole Amazon threat never played out, but these stocks have sold off as if they're vulnerable to all the other retailers. And so every exception to the rule in these sectors is the value opportunity.
And I think that's a really interesting point, because when we look at the market, we're kind of taking a similar approach where we're looking for businesses that have, you know, understandable cash flows, healthy stream of income getting spit off, but aren't overly expensive. Like, you know, on the one hand, the growth stocks that we were talking about today. On the other hand, things like utilities and consumer staples broadly. It's almost this look for cyclical value with a shade of income that I think is going to help people navigate through, again, what I think is going to be a choppy market during these next couple of weeks.
To the point about banks, I mean, I remember when we said banks have to take the leadership, and we waited and it never happened. Is that an indictment of the overall rally that we've had this year?
I think it's a sign. You know, I think one of the things that's giving the banks a little bit of trouble is if you look at what's gone on from an economic growth standpoint over the past couple of quarters, you know, the softening on the manufacturing side has been offset by strength in services and consumption. Now we have manufacturing, which is kind of still muddling through, but a consumer which is coming back down to earth. And so this broad-based softening in final demand, I think gives people a little bit of pause about the performance of the financial sector going forward and the ability of banks to do what they do in an economy which is, you know, moving back below trend growth.
Why do you say the consumer is coming back down to earth?
Well, it's just the pace at which we saw consumption in the second and what we think is going to shake out in the third quarter is north of 3% in real terms. That's not sustainable, particularly given the slowdown in employment growth and the softening in confidence. I mean, we saw the same thing in 15 and 16, but you only get so much legs out of the consumer before things need to slide the other way.
I mean, the flip side, Ripple, to the sort of negative case, I get the fact that it's going to be hard to make a trade deal and we can't grow forever. But the Fed is engaged. I mean, the Fed is now in easy policy mode, cutting interest rates, watching the data, watching the trade tensions, and ready to step in if needed. And it's a powerful call to say, fight the Fed.
Well, I've been covering Japan and global equity markets for 20 years, and QE was first tried in Japan, and it failed. Ultimately, you know, corporate balance sheets had to improve. And so I think that this is going to be a journey for American and Anglo-Saxon investors. This is not the first time this is happening in the world. And if QE is the way to succeed, why did Japan fail? They tried it in bigger form, faster, earlier than anybody else. And that sort of goes back to why value has been a head fake in terms of its exposure, is because banks are extremely sensitive to this QE syndrome that Anglo-Saxon investors face for the first time. As a value investor, I don't own any banks in my portfolio of any size, and that's the reason why. It's a head fake. The business of banking has fundamentally changed for the worse. And so I think the value is found elsewhere. A lot of value investors over-reliant on banks to lead them out. That was a mistake.
Even though the relative performance of U.S. banks over European banks doesn't attract you?
Well, this is going to be a case where U.S. lags the rest of the world in terms of its banking sector, falling and falling and falling, because rates are reversing course. The whole expectation of the U.S. banking sector was rates would rise. We know that's not happening. In fact, it's the opposite. So I think the unthinkable is now thinkable, that we could actually move towards far lower rates. And that's going to be an enormous headwind for the banking sector, no matter how good a bank you are.
But in the interim, I think it is interesting that if you look at total shareholder yield, you are getting the most bang from your buck out of the financial sector. So for people who feel like maybe this market is lacking a catalyst to take another step higher, banks potentially in the short to medium term, I would argue, could be an okay place to hang out, wait and see, clip a healthy coupon, and get that buybacks as a tailwind as well.